All right. Thanks very much for the kind introduction, Rushi. Okay, and good evening to everyone present. Thank you for joining us today. On behalf of the Kenanga Investors team, we're grateful for you to spend your evening with us, even though I understand it's pretty late. And also, a special thanks to FSM1 for hosting us this evening. So the topic today we are talking about is Malaysian equities. But I also like to draw your attention to our title today, which is Watch the Shifting Sands, Navigating the Incoming Inflection Points. Because I think this theme, which is inflection points, this will be a key theme in the presentation today. As we know, change is constant, but inflection points, meaning to say changes where things go in the opposite direction where they have been going before. This will be an important factor coming up over the next, on the 12 to 18-month horizon. And these, in fact, may be factors that have not been changing over the past 1 or 2 years or even longer than that. So, it's as far as equity investments are concerned, we are pretty alert as to how this may affect our investments, and therefore our strategy should also incorporate some of these potential changes. Now, our topic today will mainly be focused ultimately on Malaysian equities, but given how connected the world is nowadays, we do have to take a look at how things are progressing globally first. So, our outlook will encompass that part first before moving on to Malaysia. And of course, towards the end, I will talk a little bit on some of the funds that we have on offer. So now we talk about the global markets, and we begin with how the markets performed last year. Now I understand, there was a large influx of new CDS accounts opening last year, and potentially, quite a lot of people made money last year. But how did markets actually fare in 2020? It was actually quite mixed when you look at it from a global perspective. Where did the split happen? It was actually a pretty strict difference between the markets, and the key factor was how much tech exposure did those markets have. So in places like the US Nasdaq, the Korean index, as well as Taiwan, you were looking at above 20 to 30% returns for 2020. Whereas countries focus on more traditional trade or tourism sectors, for example, Singapore, Thailand, Hong Kong, all of these saw negative returns for the year. And what has changed in 2021 year to date? The truth is not too much. A lot of the winners kept winning. You can see the US index, Taiwan, Korea that I've talked about, all of these are still doing double-digit returns. And besides that, countries that have done well in containing COVID-19 have basically recouped some of the losses that they've made last year. So examples of this include things like Europe, as well as Singapore. Now, unfortunately, the domestic market has not done very well. Due to the timing, we've only gotten 25th June as a cutoff point in our presentation today. I believe as of first half of the year, the KLCI is down roughly 5.8%. We will delve into a little bit. We'll delve more into what happened locally later on. But again, a key factor moving markets from last year to this year is COVID-19. So what to look at when you look at COVID-19? I think it's easy to look at the infection stats, the daily new cases, and for most people, they probably track that quite regularly anyways. But more telling, I think, for us is how the global vaccination progress is going. And the truth is, it's been going relatively well. I think as of late June, there's been more than 2.8 billion vaccines dispensed globally. And this was quite a jump from less than 2 billion, I think, at end of May. So with the progress, I think we are starting to see more bullish expectations as to when what they call herd immunity can be achieved, which is vaccinating a sufficient proportion of your total population. If the pace maintains, most countries, for example, the US is looking as early as September, and similarly for the EU. The UK, of course, they are projecting a slight even earlier than that, potentially in August. But no doubt, I think sentiment has been a little bit more sour recently, given the fact that they have seen a renewed rise in cases owing to the so-called Delta variant. And is there a split in terms of vaccination rate globally? Yes, quite obviously so. Asian countries have been lagging, the same for Malaysia as well. But as we go later on, you'll find that some of the progress on this front has been picking up very substantially over the past couple of weeks. So again, the point where we see when we see vaccinations hit a bit of a critical mass, I think this is where a potential inflection point lies. Not because of we want to reduce, let's say, the normal total number of cases, which is of course that's still the main goal and still very important. But tracking the vaccination progress is what informs us as to how countries may potentially start adjusting how their reopening plans go. And I think this can be seen as early as now in terms of the data. So if we look at US, their reopening has actually started quite some time ago. Of course, it's still very dependent on a state-by-state basis. And even till today, certain areas have mask mandates, certain areas don't. To an extent, it's become a little bit politicized. But the fact that they've reopened early due to their very fast vaccination rate has had a very strong impact on their economic condition. So the second quarter GDP that's expected to rise as much as 12.8% year on year. Keep in mind the first quarter was still relatively flattish on a year-on-year basis. So the second quarter, owing to the large fall last year, it's probably when you're going to see a very large jump, in part due to the low base effect. Now, this is expected to slightly cool towards the 6.7, 6.8% in the subsequent quarters, but full year expectations are still relatively high at 6.5%. And what's adding on to this is that fiscal stimulus in the US is still ongoing. The so-called American Rescue Plan, worth roughly $1.9 trillion, was announced and cleared, I think, in March. And then recently, they're still working on passing another $1.2 trillion infrastructure bill through their Congress. Now, I'm not just showing these figures because they are sizable or they are important. I mean, this is a huge component of their GDP, and if there is a multiplier effect, we may very well see the growth rate exceeding the 6.5% expected year on year for 2021. Now, where this figure may start to taper off will only happen towards perhaps second quarter of next year or third quarter of next year, where you can see the street expects it to taper to below 5% or below 4%. So this gives us a pretty long runway as far as we're concerned in terms of growth expectations. So whether some of these figures may eventually be revised up if this year does better than expected, that remains a bit of a catalyst for them. Now, the US story comes with another very large component, and I will spend a little bit more time on this slide because this is another key inflection point that we are paying a lot of attention to. So what's happening with liquidity in the United States, which translates, of course, to liquidity globally. So what's happening now is, first, the US Fed has committed to maintain near zero rates until the labor market returns to maximum employment. And in the meantime, they claim to accept higher than average inflation rate. Now, just to recap, the Fed fund rates have been reduced to a high end of the 25 basis point at the start of last year. So because of this, it's near zero and liquidity conditions have been flush. And besides that, there was quantitative easing in the form of asset purchases by the Fed ever since by roughly $120 billion per month. So in many ways, this is theorized to be the reason why the US market continues to be strong, why valuations continue to be high for both the US as well as global markets. Now, what has happened over the past couple of months? First is inflation has made a return. Again, just to give a point of reference, the Fed anchors its long-term inflation as the targeted inflation range at roughly 2%. But the CPI over the past couple of months, for various reasons, have spiked. And then the May showed the highest reading in close to a decade at 5% year on year. Now, in many cases, people have been partially expecting this, and we have been allocating, this factor. We have been calling the inflation risk transitory, and in fact, this is similar to the language that the U.S. Fed is using. Transitory, that is to say that inflation may be high for a short period of time, but as things adjust over time, we will go back to the long-term inflation rate of 2%. Now, that being said, the June Fed meeting gave a little bit of a surprise when they revised their projected rate expectations to come to 2 hikes by the end of 2023, rather than initial guidance of the hike happening only in 2024. Now, 2023 still feels like a long time away, but I think, clearly what the market is more concerned about is, what if inflation continues to surprise over the next couple of months? And, number one, how high can inflation go? Number two, how much more forward can these rate expectations be brought forward to? And more importantly to this is the quantitative easing that's happening at $120 billion per month. This amount is still, this is still being translated into real asset purchases. And, the trimming of this may result in what they've called a taper tantrum, similar to what we've seen in 2011, where markets try to react ahead of this reduction in asset purchases every month. Now, that being said, this is a very large risk point, but what is our official view on this? For now, we still view inflation as transitory. Now, that's not just because it's a consensus view. I think there's a very good reason for it. Most of the recent inflation is driven more by supply constraints rather than excessive demand. The employment rate in the US is still below its maximum employment. I think recent readings were 5.8 to 5.9% unemployment, while pre-COVID they were doing below 4%. And inflation has been contributed to by things that can be seen as one-off. For example, you may recall the Suez Canal blockage incident back in March. This has resulted in, number one, a lot of delays in shipments. Number two, skyrocketing container shipping rates. News have picked up that container shippings from certain regions, for example, Asia to Europe, has spiked more than 5 times compared to previous years. So all these kind of issues are real and they do impact businesses. But at the same time, it is transitory. It is a matter of time until these things go back to normal. So because of this, excessive fear on recent inflation readings, I think should be taken with a grain of salt. But nevertheless, I think the liquidity impact is real. The tapering, if any, the impact is real, and this is something to monitor. Okay, moving on from the US, we'll just talk a little bit about Europe. So compared to the US, they were they were more severely hurt back in 2020, especially in the second quarter. And because of that, we do see a much larger rebound effect this year. Even though Europe as a region is much more diversified compared to the US. So because of this, the recovery rate is also expected to be a little bit more staggered. Vaccination rates was trailing slightly behind the US, but this has been catching up recently. And another point to note is that their full year GDP growth, it is on an absolute basis lower than what's expected for the US. This is only 4.5%. So what's the other important thing to note about Europe is the ECB is also a very large contributor to global liquidity conditions. And they also have a form of quantitative easing in place ever since the COVID hit. They call it the Pandemic Emergency Purchase Program. And unlike the US, we do have a little bit of a timeline as to when these asset purchases will taper off. They are doing roughly 80 billion euros a month. And this is expected to last until March 2022. Now, the thing is, of course, the tapering and reduction of this asset purchase program may be a slight negative, but at the same time, the ECB, unlike the US, seems to be less likely to react in terms of adjusting its key interest rate. There's a few reasons for this, one of which is inflation. Inflation in Europe is still relatively tempered. I think when you look at the June figure, they were still doing less than 2%. So, well within range of what they are comfortable with. And another thing is the ECB has famously been implementing negative rates. Their key deposit rate has been negative since 2014. And right now, I believe it's negative 0.5%. So even if there is a rate adjustment coming out from the ECB, this is not likely to be as impactful in terms of the quantum of change compared to if the US Fed moves. A negative 0.4 rate versus negative 0.5 isn't going to move the needle as much in terms of capital flows in and out of the region. Now we turn towards China, and China, unlike the others, do have a little bit of a different schedule. As you can remember, they were impacted a little bit earlier from COVID. They were hit in the first quarter of last year versus the second quarter for most other nations. And because of that, first quarter showed the rebound much ahead of the others. And at the same time, because of its importance in the global supply chain, the recovery in other countries will also drive performance for China. And because of that, exports have been doing well. Certain external sectors, including investment, has been doing well. And they are quite likely to go ahead of their initial growth targets of roughly 6% in terms of GDP. In fact, I understand the street is still looking at above 8% this year. But more crucially for China is how their policy moves might go. Again, this has been captured in the news pretty heavily recently. They've gone through the 100-year anniversary for the CCP, if I'm not mistaken. And a key factor that will affect our view of China going forward is how strictly or how swiftly some of its policy measures are being enforced. So some of the key factors they are looking at is, number one, their indebtedness is getting pretty high. I think they reached a total debt to GDP of 281% at the end of last year. And they've come out very strongly against things such as pollution and carbon emissions, and have put forward a carbon neutrality target of 2060. And at the same time, there's a lot of lip service given into the sustainability of some of its growth and some of its industry. You may have seen news of them, insisting on cracking down on what they call empty infrastructure growth to make sure some of the growth is real and it's usable. So because of this, some of the policy actions that we're expecting to take place starting now or over a period of 1 to 2 years include some credit tightening. In the past, this has been a little bit negative in terms of its impact on GDP. As you can see in our chart on the bottom left, there's a bit of a lag effect, but ultimately that does affect nominal GDP growth. At the same time, the energy mix in China is slowly starting to shift towards more renewables. So because of this, the way some of the corporates are operating now, some of the cost base, some of these things will change quite substantially over the next couple of years. So this should be factored in, when making investments in China as well. And at the same time, a more recent development is anti-monopoly or data security controls of some of the tech companies. And this has affected multiple listed entities, including the most recent one as Didi Global, which just listed in the US and subsequently had their app clamped down on in China. It just happening the last couple of days. Moving on from China, we'll just talk a little bit of commodities that had a very strong run over the end of last year and then to the start of this year as well. For a lot of traditionalists, copper, which is seen as an indicator of the global economy, they've actually peaked in May at above $10,000 per ton. But again, owing to the resumption of supply and also to a separate degree, China has clamped down in terms of the excessive price hikes by releasing some of the state reserves. A lot of the commodities have seen their prices come off peak and been stabilizing ever since June. So again, this lends credence to our view that inflation ultimately is a little bit of a transitory issue, even if the headline figure for inflation may surprise on the upside in the near term. Capping off the outlook from a global perspective, first, growth is still strong, but the rate of change you should expect that to taper off when we come towards the end of this year and especially towards the middle of next year. On the other hand, policy is still very stimulative, especially from a monetary perspective. And at the same time, the US has the benefit of still strong fiscal policies. Now, equities, we think they are in a little bit of a period of consolidation. While fundamentals are still strong, I think there's still a lot of concerns about the outlook for liquidity. And at the same time, people are basically looking at a time where the growth rate is starting to taper. Once you come off a high base, then that's basically where the risk is, because that's where the excitement kind of tapers off as well. And again, recapping some of the risks we look at globally, inflation, that's the prime one, policy issues from China, and of course, at a more general level, the pace of vaccinations plus the risk of new variants. I mean, that will be an ongoing risk for the foreseeable future. Okay, tying up the foreign sector, now we now look locally into Malaysia. Now, as I've alluded to earlier, Malaysia has had a pretty rough 2021 to date. We've had the market correcting more than 5% as of middle of the year. But of course, the story is a little bit different once you delve into when you delve into it from a sector by sector basis. What has been the driver of our performance last year and then the decline this year? I think the easy answer to that question is the glove sector. They were a huge outperformer last year, I think. In terms of the Bursa Malaysia Healthcare Index, they rose 185%. And then at the same time, this year, they have given up, I believe, more than 20% as at end of June. Now, besides this huge swing factor, what else has been happening? In fact, a lot of it tracks what has been happening globally. The tech sector was a huge winner last year and continues to be a winner this year. We've seen some winners in terms of the industrial space, also typically more related to the tech or electronics engineering segment. And then a little bit more stable or domestic catalyst-driven sectors such as transport and telcos have been doing rather fine as well. Now, the issue is surprisingly the commodities-related segments such as energy and plantations. So these have done pretty poorly, even though, as I've mentioned earlier, these two sectors, commodities on general have been trending upwards. So what's a huge factor dragging some of the more traditional or consumer-related industries? First, I think the most straightforward is the COVID cases. When we were preparing these slides, we rather optimistically said that cases have been averaging 5,000 to 6,000 daily, and I think today we have done above 7,000. But I think even back then the signs were there that the situation has not really calmed down. The R0 or infectivity rate was already near 1.0 at the time. Again, a precursor to potentially more cases down the road. And even adjusting for population, Malaysia has been doing significantly worse in terms of new cases compared to our ASEAN peers. Even Indonesia, which recently have seen a huge resurgence in cases as well. So in reaction to this, what we are paying attention to is the National Recovery Plan by the government. So they announced this rather soon after the third or FMCO or MCO3, basically laying out a plan for which, based on a few numerical items such as new cases and the number of vaccinated people, reopening will be allowed to occur. Now, I think there's still a lot of debate as to how good or effective this policy will be. But I think as far as external investors are concerned, at least it gives a very clear or at least a very identifiable benchmark. So again, it gives you some numbers that you can track or look forward to. Now, why is reopening important? I think for multiple reasons, but first of which is there is a lot of economic losses happening on a day-to-day basis. I think how this affects the people, how it affects employment. I think that is also a very unfortunate and negative thing. But some of the losses have been resulting also in GDP cut projections. Most street economists have revised their figures down to 4 and 4.5% growth this year from initial expectations or even above 6%. And with the recent extension of the lockdowns, I think we might even see figures below this as the third quarter figures will be affected. The other risk coming from this is the fiscal deficit. We've already breached 6% last year, actually, and initial plans were to try to pull this figure back. But with the way the new cases and the new lockdowns are going, the deficit may well stay beyond this 6% figure. And because of that, there's always a slight risk of a sovereign ratings downgrade further down the line. But it's not all doom and gloom. I think there was a number of stimulus packages announced, the most recent of which was the Permule package. Now, the 150 billion figure was quite a large one, but key to note was the direct fiscal injections, because this is where you see the very significant or immediate impact. And then typically, it does bring with it a little bit of a multiplier effect. So this came to roughly 10 billion in the recent rounds, and the total cumulative figure coming from the very first Prihatin package until now is roughly 83 billion ringgit. And that's close to 6% of GDP. So, number one, this is important in terms of alleviating the people's troubles, but at the same time, it is a little bit of a buffer to keep consumption levels at least at a more stabilized rate. There are other factors that inflate this total stimulus figure. For example, this allowance of EPF withdrawals, and then also things like the automatic loan moratorium that is applied. So some of these figures do keep the stimulus package rather large, but again, we would encourage you to think about the direct fiscal injections as the more crucial figure in terms of how they may improve or aid the economic performance. Now, the key bright spot or the Q silver lining is actually coming from the vaccination rate. So as of 28 June, we've had 16% of the total population getting at least one dose of the vaccine, and over 6% completing their second dose. And in fact, the growth has been such that as of even yesterday, I believe these figures have been updated to 20% and 8% respectively. And all this owes to our increasing vaccination pace. We've already reached at least 200,000 doses per day figure since late of June. And the goals have been revised up. So we are now expecting close to 300,000 per day in July and 400,000 per day in August. And at this rate, we can actually achieve 80% of herd immunity as early as September. Now, this would have sounded as a very optimistic prediction just 1 month ago, but the figures do check out. And I think a lot of it is tied to the vaccine supply. I think keep in mind, Malaysia is not that huge of a country. And the incoming vaccine supply numbers more than 10 million count per month from July onwards. And I think that compares to roughly just 8 million in totality last month. So again, as long as the execution is done well, the vaccination pace and the number of people vaccinated could change very quickly. despite how poorly our new cases reflect on us. And in fact, when you look at it on new vaccinations on a per capita basis, Malaysia has been catching up to Singapore over the recent periods. You can see that in the second chart in this slide. And we are already far ahead of most of the ASEAN peers besides Singapore. Now, I'll sort of run through some of the other macroeconomic indicators for Malaysia. First of which is the GDP. I think we were still in the negative in first quarter. And then, but a key bright spot here is our net exports have been doing well. And in fact, this is a good indicator that the GDP performance might subsequently improve on a Q-on-Q basis, if not for the lockdowns. While first quarter was negative, second quarter will have the low base effect. Keep in mind, it declined roughly 17% in the second quarter of last year. And so even though we are starting to see the lockdown impacts in June, we'll still see a positive year-on-year growth figure. The key point, I think, will actually become what 3Q21 will look like. And that's still very much reliant on how the vaccination pace goes and how reopenings go. Because as far as things are looking now, July might be a pretty poor month in totality. At the same time, our interest rates are expected to be maintained at a relatively low level. BNM kept it steady at 1.75% in May. Keep in mind, this was reduced quite drastically. It was 3% at the start of 2020. They do have a meeting sometime this week, and even though you may see news of potentially encouraging BNM to cut rates in response to the additional lockdowns, but I think the street is still clearly not pricing this in. I think BNM may feel a move now as a little bit late, and because of that, basically rates are expected to be maintained as far as until the middle of next year. And somewhat like what we see globally, inflation is on the rise. There is a low base effect to be concerned with, but the May CPI figure as well as April was still relatively high at above 4%. But that being said, I think as I've mentioned, it's a bit of a consensus view that this will be transitory. In fact, when you strip out the transport cost effect, core CPI is still quite low and below 1%. And the 5 month CPI for 2021 is actually still only up 2.1%. So I think, again, the key takeaway here is rates should maintain for Malaysia in the near term. And tying in closely with that, we expect the ringgit to be relatively stable as well. I think recently it has somewhat weakened, especially in reaction to the news that US may be looking at a little bit of an earlier tapering. Because of this, the dollar has gained a little bit of strength, and again, that reflects weekly. That has reflected in a slightly weaker currency from Malaysia as well as other developing economies. So with our external reserves still at a very high level, it's close to 111 billion US dollars. This is highest it's been for the past 4 to 5 years. We expect the external position to be relatively strong. We are still running a current account surplus as of end of last year. So because of this, I think there is a lot of room still for the ringgit to strengthen. And in fact, I think most street economists are expecting the ringgit to strengthen even further below the 4.1 level towards the end of this year. Exports have been strong. I think this doesn't need much explanation, again, explaining why the current account remains in surplus. Multiple sectors are doing well, including electrical and electronic products, rubber, as well as palm oil. And this is expected to maintain strong because our key trade partners, as we've brought about earlier, are all expected to do better, especially moving towards the second half of this year. Now, the government does have the opportunity to pump prime. I can understand this factor is a little bit more of a question mark with Malaysian politics being the way it is now. But I think the key takeaway is there is a potential in terms of new projects, in terms of idle or ongoing projects for the pump priming to happen. In fact, on paper, our development expenditure was supposed to rise as much as 38% this year to 69 billion ringgit. But at this stage, we can probably assume that's probably going to miss initial expectations. So, there's still a lot of projects that I think, have room to run or have room to be pump primed by the government. Just an example of something that they kind of had to accommodate recently was the MRT3 plan. Well, because of their fiscal position, they were not really keen on pushing this through. Ultimately, it was kind of, shouldered through by involving a lot more private funding and extending the construction period to 10 years. So, when you think about projects such as the Pan Borneo expansion and some of the East Coast Railway packages, some of these may eventually be utilized when and whenever it's possible, as far as the government's fiscal position is concerned. Another key bright spot is corporate earnings. While 2020 and 2019, we've seen a streak of declines. 2021, the street still expects as high as a 42% rebound. Now, you might think, well, of course, a large part of that is due to the inclusion of gloves. But, after checking with brokers and the various analysts, even stripping out the gloves effect, there's still a rebound story of at least 20 to 30% earnings as far as all the KLCI constituents are concerned. And in the meantime, earnings performance have been doing well. First quarter had a pretty large number of earnings beats at 25%, which is quite rare for Malaysia. That being said, second quarter will likely to show a little bit more disappointments now that the MCO3 impact was implemented. So how Malaysia's overall outlook has affected our regional positioning. And the key takeaway is it has not reflected well. Foreign investors has been a net seller for many years now. And the year-to-date net sell, I think this figure is not too updated as it was at 25th June, but it reached just over 4 billion as at middle of this year. So, it's still a negative figure, but I think the positive takeaway from it is that the foreign shareholding has reached basically historical low levels. It's just above 20% as end of May and end of June as well. So whenever some of these foreign selling either reverses or inflects, I think that again is a positive opportunity for more local equities. What is holding them back? And perhaps, what is kind of an overhang for local investors as well? I think a political risk is ultimately still a pretty large factor. We may have gotten used to it, but ever since the start of last year, the political scene here is actually not normal by any means. And the thing is, at this point, people are still unsure of how a potential coalition would look like, let alone who might win a potential election. So, there's a multiple risk element to this that will keep the foreign flows at bay for the near term. So, again, there is opportunity for that when you look slightly ahead, but in the meantime, it is a bit of a drag. And ultimately, how does this play out into valuations? KLCI has been very unusually the cheapest market in all of ASEAN ever since late of last year. So again, part of this is due to the inclusion of gloves into our index. But at the same time, even if you strip that out, our price to earnings ratio has trended far below some of our peers, especially some which in the past we always commanded a premium to. So this spells, I think, a lot of opportunity, especially as we move towards a more normalized economic conditions. So ultimately, again, the vaccination rate and the total number of people vaccinated still play a very key role in how valuations will go. And keep in mind, this is anchoring onto the fact that our corporate earnings are still expected to do relatively well this year, and then next year as well. Okay, summing up the domestic outlook for us. Number one, a few key trends. Number one, monetary policy will be accommodative. Second, vaccinations are expected to pick up. Corporate earnings still gonna do well, and we do have a lot of headroom as far as foreign shareholding is concerned. Now there's a pretty long list of risks to monitor as well. New waves or new jump in cases of COVID-19, risk of sovereign rating downgrades. This will affect the fixed income market as well as equities. Political uncertainty, and of course, looking at the US and China factor. Number one, whether or not there's excessive clamping down or tapering from either of these countries, or whether there's a renewal of some of the inter-country tensions, because this has kind of a factor that's been muted for some time due to the COVID scenario. So in reaction to this outlook, what is the strategy we'll employ? So this is probably one of the most important slides that we have today. What we have been adopting is what we call the barbell strategy. So that is to say, barbell, thin in the middle, and the weights are slanted towards two opposite ends. So in this case for us, this is the two key trends that we have weights on both sides. Number one, the recovery theme on one end. On the other end, the growth and mega trends that we expect to persist. The recovery theme is relatively straightforward. I think some people may just describe it as beaten down stocks. The truth is, of course, when you look into it, there are a lot of mini themes inside that you would expect to benefit as the economy recovers, as reopenings happen. So financials, are pretty, as a sector, is a pretty straightforward play on economic recovery. Certain commodities, some of these, again, benefit from the improvement in demand, improvement in their respective supply chain or labor conditions, improvement in consumption. So this includes things such as retail, as well as leisure and travel, things that are basically, not allowed or basically barred from operating smoothly at present. And as well as construction or value plays. I think some of these, are disrupted quite heavily by the lockdowns now, and their valuations have fallen to multi-year lows. Now, on the other end of the barbell strategy, some of these are themes that are very popular. You probably have heard them from us, from other investment houses. So these themes are not ones that we are keen to shy away from now or yet. So the technology theme, including new developments in IoT, potential growth in AI, and of course the 5G story, which is improving the replacement rate of some of your handsets as well as other IT devices. The trade diversion story remains very strong. So this means the technology or electronics manufacturing segment moving towards regions like Malaysia for cost competitiveness reasons. Excuse me. Renewable energy, also a very important theme, given we expect its share to increase in the power generation, not just overseas, but locally as well. And ESG, I think this will become an increasingly more transparent theme in the years to come, especially as we see improved data capture and data comparisons between companies. This will become a more actionable theme, though, it has kind of been in the news and, been talked about for some time now, but it will become a little bit more practical as time goes on. Okay, just for the last few minutes, I'll run through some of the fund performances just to give a highlight of how we've been doing year to date. So some of our key funds, have been doing quite fine year to date, outperforming some of their respective benchmarks. But I would like to draw your attention to the 3 and 5 year performance. So this is, where I think is more reflective of our strategy, where we are bottom up fundamentally driven stock pickers. And the key point of our strategy is to produce long-term risk-adjusted outperformance. So, we are taking the long view, and I think some of the historical performance reflects well on that. This next slide shows more or less the same thing, the performance, but in a calendar year form. And just to highlight the Malaysian Conventional Equity Fund, this is our flagship, which is Kenanga Growth Fund. So again, it has done very well in terms of rankings, and we do expect it to continue performing decently. And for the last, at the end, I would like to tie into some of the recently relaunched funds from us. We do have the Kenanga Global Growth Fund. So this has been relaunched to include a more global international investment theme. So it's invested primarily in equities, but also with an allowance for a certain amount of fixed income or money market instruments. And with the relaunch, we do intend to invest this mostly in foreign markets, including the US. So this does provide a number of diversification benefits. And some of the target sector weights are reflective of the barbell strategy I talked about earlier. So, this will be all managed in-house and using the same strategy of bottom-up stock picking. So, we think there is a little bit of a diversification benefit from this. And together with that one, there's the relaunch Kenanga Global Islamic Fund as well. So that provides the Sharia compliant version of a pretty similar strategy. All right. Okay, I think that kind of sums up what I have for now. So, I'll gladly move on to the Q&A session. Thank you.
Sure, Marvin, thank you so much for your presentation. We have a few questions coming from the audience. I think we'll just start straight away with there's one question from an audience asking what's your view on the financial sectors in local Malaysia? And then there's three parts to the question. Another one would be growth sectors. Is the growth sector still attractive? And the third one is commodity or energy sectors. Do you have a positive outlook for these two sectors?
Okay, yeah, I'll just tackle them one by one.
Sure.
Okay, so the first one on Malaysian financials. So, in general, this kind of refers to the banks. And on the whole, yes, we do like them as part of the reopening team. I will go back to the slide on our strategy. So financials have a direct play into the economic recovery team, but I think just going a little bit more technical on this front, a lot of them are guiding or expecting lower credit costs this year. And this is even though we expect, the extended government moratorium, even though the lockdowns have been extended, because a lot of the banks have provided more than necessary ever since last year. So fundamentally, they are doing well and valuations are still very palatable for most of them. So, on a broad basis, we do like the financial sector. Now, sorry, Rushi, could you remind me the second question?
You mentioned about growth sectors just now. So the second question is with regards to growth sector, do you find this sector still attractive?
The glove sector?
Yes.
Okay, so the glove sector, as you can see from the market performance, have had a very rough time. I think the question has shifted from when will prices start trending down, and now the question has become more towards where the bottom might be for prices. So, sort of similar to when the previous question was being asked, which is when prices might start turning the other way. Whenever this kind of question is being asked, basically sentiment will be a little bit more cautious. And I think that's going to play out until the question is answered, basically. But at the same time, when you take a slightly longer view, the glove companies have been through a lot, basically, over the past year. They have expanded, because it was required by a very significant amount. A lot of their labor practices were questioned and, basically put through a lot of scrutiny. So a lot of the companies will come out better for it, especially when you take a longer view. So, we are not completely writing them off, but at the same time, I think near term, before the question is answered, and just to recap, the question is, how far can selling prices go? Before this question is answered, it is a little bit of, I think sentiment should be cautious.
All right. The final question is commodity or energy sectors. Do you have a positive outlook?
Yeah, so commodities and energy, I think, referring more towards the oil and gas segment. Now, the thing is, prices are actually expected to maintain at current levels or with an upside bias. I think you may have seen news recently where, OPEC kind of stopped discussions and in terms of, how soon they might start controlling or releasing output. And because of that, oil prices reacted positively. So the truth is they are facing an upward slope in terms of demand, expecting to recover. Now, the issue with that is number one, there's still a lot of capacity. So even though prices may be, in a sense, controlled and be kept on an upward slope, long-term pricing is still relatively negative for most people. And in terms of oil and gas players locally, a lot of them have been, doing a kind of average or not so well over the last few years, even when the oil prices started to recover since last year. So on the whole, while we do see positive spots from the oil prices staying strong, I think your exposure has to be a little bit more careful because some companies will not be able to take advantage of that.
I see. All right.
Yeah.
Thank you for your answer. Next question is about the overnight policy rate. Yeah. So the question is, what is your view on OPR, and would you discount any future rate cuts going forward if the decision is maintained?
Yep. So our view is the Bank Negara is likely to keep rates steady, and will Bank Negara be incentivized to cut it further? Our view is no. Basically, because of the potential effect it has on the ringgit. With a lot of other countries, I think most notably the US Fed talking about tapering already. I think central banks have to be very careful about how they position their potential rate outlook, because if you move in contrast to them, the effect on your currency can be kind of severe. And I think Indonesia, like Malaysia, is sort of in this same situation, where it would be nice if we could lower the interest rate. It potentially could help, but at the same time, there'll be a lot more sectors affected if your currency weakens significantly.
I see. All right. Thank you. Next question, with regards to investment. So, will you suggest investors to overweight local or Asian equity funds at this juncture?
Overweight Asian or local or equity funds?
Or maybe both.
Okay. Okay, the thing is, so, obviously I am focused on equity, so my answer is a little bit biased. But I will say that, when you say overweight local or Asian equities in reference to, for example, fixed income, I would say the answer to that is there's a good case for that. Fixed income, money market or bond yields have been relatively tame and relatively low because of the interest rate scenario. Now, in terms of the risk towards rates going forward, it does lean upwards in our view. And because of this, while fixed income is generally expected to do well and expected to maintain steady, there is, you could say a sort of a downside risk that wasn't there previously. And when all the interest rates were on a downward slope. So I think, there's still a lot of the upside to be captured from equities, especially from either a domestic or Asian perspective. So I think keeping higher weights there still makes a lot of sense. But of course, again, I'm speaking as an equity investor. So I'm sure, a more balanced wealth manager, for example, might have a different perspective.
No problem. Okay, next question is, are you concerned with the expensive valuation of the US stocks, especially the technology sector?
To answer that simply, yes. I mean, the payback, basically the payback expectations implied by very high valuations is, to a certain sense, it's becoming increasingly hard to justify, except for the fact that liquidity conditions are flush. So this ties back again to earlier on, what I mentioned, the inflection point that you should be very concerned about, that you should pay attention to a lot, is basically, how soon monetary tightening may come. So a lot of these valuations are fine when you're essentially, having liquidity for cheap or for free. So, high valuations basically mean a lot of these tech companies or, certain US platform-based companies can grow without having the need to make sure they have a positive return, that is to say, to make a profit. But the moment liquidity conditions change, this strategy will have to change as well. So yeah, it's an area of worth monitoring at the very least.
I see. Okay, in your slides, you did mention property being one of the recovery team, right? This property sector. So we have a question from an audience is that in terms of the recovery, do you expect the property stocks to outperform? Because according to this question, sales have been strong recently.
Yeah. So property sales have been strong for the same reason, the stock market has kind of been elevated. That is to say, liquidity conditions are flush, and then people are starting to see, hey, where can I put money to more effective use? And property, besides being a real asset, is also an investment class. So in terms of property stocks, do we expect them to do well? I think certain ones, yes. Certain small property companies, their valuations have hit multi-year lows. In terms of earnings performance, they're expected to do quite well. And so when you contrast those two factors together, some of the companies, you can look at them and say, hey, they're only trading at less than 10 times, 6 to 8 times price to earnings going forward. So there's a little bit so there's a catalyst for them to outperform for sure. Now the main if there's a risk, I think you should be concerned about if you're playing this team, it would be the fact that this sales could be in quite a bit of a one-off. So the moment you move towards second half of this year or moving towards next year, and then locally, let's say the home ownership campaign is not extended, some of these sales may ease off quite sharply. So in terms of a positive view on them, it's still a little bit of a yes from us. But at the same time, I think the timeline is quite tight, basically. So it's something to be careful of.
I see. Okay, maybe we take one final question. Just now, with regards to the slides on your new global fund from one investor, would it be more biased to a certain or several sectors, or is divided among to all sectors? Maybe he's asking more to the underlying, holdings of the sectors.
Yeah, sure. So yeah, this is mentioned in the slide. So for the relaunch Kenanga Global Growth Fund, again, our weightage would reflect basically our views on the market. So for example, in this case, we are targeting to have roughly 55% US exposure, then Europe 10%, China, Hong Kong 15%. And then in terms of sector, the overweights will be in reflection of the weightage of the benchmark. In this case, the benchmark for this one will be the MSCI All Countries World Index. So we do have intentions of overweighting things like financials, in overweighting things like industrials, and things to a smaller extent, materials of energy. Now you may see that, we're actually neutral or technology here. But again, this is to counteract that, I think this is reflective of the high benchmark weight this sector has already. Yeah.
I see. All right. Thank you so much, Marvin, for the presentation, for the insightful presentation. Ladies and gentlemen, there's still some questions that unfortunately we couldn't take for this session. Don't worry. If you have any more questions, feel free to actually email to our client investment specialist at investhealth.ny@funsupermart.com. Yeah, okay, thank you, Marvin. Thank you to Community Investors for making this event happen tonight. So, ladies and gentlemen, tomorrow we will be having our next session. Yeah, we'll keep continuing the recommended fund webinar series. And tomorrow we have Principal Asset Management to share their views on the Asian markets. Same time tomorrow at 8 p.m. We see you tomorrow. Thank you, everyone. Good night and stay safe. Bye.
Okay, thank you.